Today we're going to take a look at 5 great things and reasons of trading weekly options. Stay tuned, I'm going to give you some thoughts. All right, so if you're brand new to trading options and you haven't heard about weeklies, weeklies are basically shorter duration options, but they don't have to be shorter duration options. Back in the day when they didn't have weeklies, you could just trade the 30-day options with only 7 days to go if you wanted to, 5 days to go, 3 days to go, whatever the case is. Now what they have is just more options, more option contracts. Some expire on Monday, Wednesday, Friday. So you've got a lot of different things. And if you want to take a look at some weeklies, you basically can go in and pull out any stock that you want. Let's pull out the Qs and take a look. You'll see the weeklies here on this Thinkorswim platform in TD Ameritrade. Notice all these in yellow, they are basically weekly options. And then when you get into regular stocks, just to show you as well, all the ones here in yellow are the weeklies or non-standard expiration days. Whereas here, those are kind of more of the standard options. So you'll notice they have weeklies, quite a bit of weeklies out there, and that means you could trade more often or at least spread out your risk across different durations, which makes it fairly flexible. Just the market is fairly liquid these days. So if we're looking at the huge benefits to trading these weeklies, there's kind of 5 main benefits. Here they are. We've got Theta. Theta is huge when you're trading weeklies because you're usually doing shorter duration. You've also got no Vega risk, or at least very limited Vega risk. Because your Theta is big. You can compound your earnings. So anytime you're making money, you're compounding them. And then you can also change your position quickly. So one week you might do bullish, another week you might do bearish. So you're able to flip-flop your positions if you like, and you can trade more frequently. And that's part of the compounding earnings. So let's break these things down. We're going to look at the Theta first. And the Theta is basically our time risk. And if we go into selling option premium, let's just go in and take a look at Daku here. If we go out 30 days, 38 days, and we sell a, let's just go in and sell an option contract right at the money, just to show you the difference. We can sell this contract at the 250 strike. Again, this is a naked strategy, which basically means you don't have any stock or protection or anything like that. You're just selling the option contract, and if it goes at that strike price, you get the stock. So sometimes it's good to do if you want to pick up stock at a cheaper level. So here we are getting $985 at expiration, but our Theta, the amount of time we're making, remember time decays at a certain rate and it picks up speed as it gets to 0 days till expiration. You might have 60 days and it gets faster and faster and faster as it decays. And if you're a seller, you want that decay to happen quickly. So here in this contract, we're making about $15 a day. And if you go to the time area and you start moving this forward, you can see after a handful of days, you'll make about $143, okay? So if we do this same contract, but we do it with a weekly, and we go to about 10 days, let's go to October 22nd. So here we'll take this, we'll go October 22nd. Now you'll make less credit at the end of the term, but you're doing it at a shorter duration. Now this Theta or time, you're making $31 per day of decay. So that's the big difference is you've got one that's at 15 and one that's at 31. It's basically nearly double, and that helps really pick up your speed. So if you want to trade a little more often, you could do this and you get more Theta. Now there is a disadvantage to getting this, and that is because when you do get a faster Theta, you also increase your price risk. Now let's look at the no Vega issue or problem here. So let's take a look at Amazon, since I already have a iron condor here set up, and we've got one. We're going to go one contract here. Okay, so I kind of have an iron condor set up. It's really a butterfly. But what you'll look at, and we'll spread this out a little bit further, just so we get 3210, just so we get some negative Vega here going. Okay, so now I've got this iron condor set up, and I will spread it out even wider. So we'll go, let's go to 3,000 maybe. We'll go to 3,000, and then we'll go to 3050. And that should give us enough a range in that area. and this one will go to maybe 4,000 just because Amazon is so big, and we'll go to 3350 in this area. So now we've got our iron condor kind of set up. I'll go just a little bit more on this right side by an extra 20 points so we can get a little more balanced. And there we go. So what I want you to pay attention here is that the Vega. So when you're doing trades like this, like an iron condor, and we're looking at our Theta to Vega ratio, you can see that our Theta is almost equal to our Vega, which basically means that if I have a problem with my volatility, I really don't have a big issue because my Theta compensates and pays for that Vega problem that I might have. It's almost a 1-to-1 ratio. Okay, now if I take this same spread and strategy and go into November 5th, you can see I get about a 38 Theta to 60. So this is almost a 2x difference. Okay, so let's go a little further. Let's go November 19th. Here is 22 to 62. So this is nearly a 3x difference. Let's keep going. Let's move the duration further. Okay, so now we've got December 17th, and of course you're watching this video probably a little later because I'm recording it, pre-filming it for the future. But December 17th, you could see, is almost a 6x difference, so it's a 6 times ratio. And if we go to December, right here, you're about 66 days out. So here we are currently on October 12th. You can see the difference. When you do shorter duration or weeklies, you almost get a 1-to-1, which means Vega is not a big deal. Okay, so that's a huge, awesome thing. The other thing is you can compound earnings. So let's say on a weekly, I could do, if we're looking at our days of the week, Monday, Wednesday, Friday, on a weekly, I could do one on Monday, another one on Monday, another one on Monday, another one on Monday. So I could do one every week. On a 40-day trade, it may take me this whole time period to do one single trade. So here I could do 4 trades. So even if I lose 2 of them, I might win 2 more. It allows me to kind of make back those earnings much faster. And that way, if you're going, let's say, with a $2,000 bank account, and then you're making some earnings, so you can add, $200, $200, $200. But now you can use those to, $2,246, $600 to use for your next trade and next trade and next trade. So it allows you to kind of compound that effect, which means allows you to trade more often. And when you trade more often, it allows you to have, I guess, some bad trades to be able to not hurt you as much. You could also change positions very quickly. That's one of the other good things is if you're trading weeklies, I could be non-directional on this trade. So let's say I'm back into my October 29th here. That'll be October 29th, about 17 days out. Let's say I go into October 22nd. With October 22nd, I'm 10 days out. So if I'm over here and I've got a trade going, I could be non-directional. So non-directional, I could be bullish or I could be bearish. So I could switch my opinion so that week number 1, I'm neutral. Week number 2 and 3, I'm bullish. And then week number 4, I'm now bearish. So you can flip-flop back and forth without it causing you too much pain. Whereas on a longer term trade, you kind of have to sit in that trade a bit more. And that can be a little bit more painful. So here, as we look into this, if we're looking into this type of trade, I could say, okay, well, right now I'm neutral. Next week, what I could do is say, okay, well, instead of neutral, what I could do is be a little more bullish. So I could change this iron condor. And I could say, okay, well, I'm bullish, so I could do 2 extra contracts on the put side. Or maybe double the contracts there. So now I'm a little more kind of bullish. I got a lot of short Vega, and I could even maybe bring in my put side here a little more and bring that in a little more. And this could be a little more bullish with just bringing in one side. Okay, doing more contracts on one side, 10 over here, and bringing in the put side a little closer and widening that distance could make it much more bullish because you're using a bigger spread. Or I could do it the other way, where now I could tighten this up and say, okay, well, maybe I don't want to be as bullish. Maybe I want to be actually a little more bearish. Well, I could do it like this, where I just shorten up the spread, and I could even do less contracts. So now I could go, okay, well, I'll do less contracts here, tighten up the spread, and now I'm bearish this week. So it allows you to be much more flexible in this case when you're doing this. So you could change your position quickly. So you could be bearish one day, you could be bullish another day, and you could be non-directional on another day. So all your weeks, you could be completely different. You could also stick to the same thing, bullish, 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 and eventually things will be bullish, bullish, but you are able to flip-flop. So those are kind of the big differences and some of the huge great things about doing some weekly trades. They're pretty handy, so I definitely encourage weeklies. Just remember, don't put all your money into weeklies because you do incur a larger price risk when you do trade weeklies. So anyways, I hope that helps. Check out our website if you're interested in getting more freebies and training and education at tradersfly.com, and you can grab a bunch of freebies there, or check out some of the courses in-depth specific into trading options as well. All right, thanks again for joining me. Hope you enjoyed this video and you got a lot out of it. Remember to watch this on our website so that way you get the full video experience if you're only listening on podcasts. And that is at tradersfly.com. Thanks again, and I will see you next time.